Hey everyone, and welcome to FinTech. Have you ever been told you need to start investing in stocks but don't know where to start? Or have you ever watched a stock breakdown on YouTube and wondered, where do these people get their information from? Well, in this video, I'm going to break down exactly how to pick and analyze stocks for an absolute beginner. My goal is that at the end of this video, you have exact next steps that you can take to start analyzing stocks today, like in the next 10 or 15 minutes, depending how long this video is. So consider grabbing a pencil and a piece of paper and let's get started. The first step is to decide what you want to invest in. You could invest in mutual funds, you could invest in individual stocks, or you could put your money into an index fund. For a true beginner, the recommendation generally is just to put all your money into a broad market ETF, which will track the stock market as a whole. This will give you broad diversification and will pretty much guarantee a positive return over a 20-year time horizon. But if you clicked on this video, you're probably not looking for the safer option and you're instead interested in investing in individual stocks. So step number 2 is to decide what kind of stocks you want to invest in. The three most common types of stocks that you can invest in are dividend stocks, growth stocks, and value stocks. Dividend stocks pay out a set amount or dividend usually every quarter based on the number of shares that you own. These dividends can be used to create passive income, or you can reinvest them back into the company, allowing your investment to grow over time. If you're interested in dividend investing, I read a great book around 6 or 7 years ago called The Single Best Investment by Lowell Miller. I'll link that in the description. The book is written in kind of a light-hearted, easy to understand way, so it may not appeal to more hardcore, mathematically minded investors, but it was a good introduction to this style of investing for me. The next type of investing is value investing, where you look for stocks that you can buy at a discount. This is the style of investing espoused by some truly great investors, including Warren Buffett, Charlie Munger, and Benjamin Graham. The premise behind this is pretty simple. In the short term, stocks can become undervalued due to some kind of short-term market fear surrounding that stock. This fear can result in people selling off this stock maybe more than they really should, resulting in it being undervalued. An example of this is Chipotle. Back when they had a health scare a couple years ago, the stock price dropped dramatically, even though the company fundamentals were still sound, and the stock price ended up going up over time. In the short term, the stock market is a voting machine. But in the long term, it's a weighing machine, meaning that eventually the stock's price is going to reflect the value of the underlying company. Now, there are other ways to find undervalued stocks, but looking for stocks which have some kind of fear behind them is the method that I'm most familiar with. The classic book for value investing is called The Intelligent Investor by Ben Graham. But there's also a pretty good podcast that I listen to called Invested, the Rule 1 podcast. The host there can seem a little bit kind of like a scammy Grant Cardone sometimes, but the format of the podcast is him basically explaining investing to his daughter. And I think that does a really good job of explaining at least some core concepts behind investing in the first couple dozen episodes. Quick pause here, I'm offering this information entirely for free, so if you're finding it valuable, please consider liking the video and subscribing. It only takes a second and it makes a huge difference for me. Okay, on to the next step. The last type of investing is the one that I have been the most involved with over the past 3 years, and that is growth investing. Similar to value investing, the goal with growth investing is to find companies that are undervalued, except instead of looking for companies that are undervalued today, we're looking for ones that will be undervalued in the future. Let's take for an example a company that is worth $100 per share if you were to break up the company and sell it off for parts, but the stock price is trading at $110 a share. This stock is overvalued for today, but if we factor in the fact that this company is also growing at 10% per year, that story changes a little bit. 1 year from now, the stock will be worth $110, but a year after that, it'll be worth $121, and so on and so forth. Now, in reality, you rarely see examples this concrete, but it just illustrates the fact that if you have a fast-growing company, that growth can result in the company being worth more than the stock price is reflecting today. Now, there are also a ton of other types of investing you could get into. You could do momentum investing, you could do day trading, you could do technical analysis. Now, there are merits to these types of investing, but I would caution any investor who doesn't have an advanced mathematics background or access to a supercomputer to not think that they've found some kind of pattern that they can exploit forever in the market. In general, these patterns are very short-lived and they're actively being exploited by the big banks on Wall Street, which do have people who have advanced mathematics degrees and supercomputers looking for them. This means that you're fighting in a zero-sum game against these people with almost unlimited resources actively trying to take your money. So at this point, you've decided what type of investing you want to do, and now it's time to start doing your homework. A good place to start for beginners is just to build out a list of stocks that you want to look into. You can do this by watching YouTube videos, looking at companies in the news, or just thinking about products that you like to use in your everyday life. After all, if you like a particular product, chances are other people like that product too, so it's not a bad place to start when looking for potential investments. Your goal here is just to gather a short list of stocks. I probably wouldn't look at more than 10 at a time, and then later we're going to take this list and start analyzing these companies in more detail. So once you have this list of stocks picked out, you can start to look into which ones seem to be good investments and which ones are bad investments. Now I'm going to show you how to do this, but remember, when you're looking into what are good companies, you're not just looking at a stock symbol on a page, you're looking at a real company with real people and real products. Focus on how you think the company is performing now or will perform in the future, rather than focusing on what you think the stock price is going to do. Just remember that in a long term, a stock's price will reflect what that company's value is actually worth, while in the short term, that stock price can be almost entirely random. A good place to start out with analyzing a stock is just to look up some background on the individual company. Look at what they do better than their competitors, as well as how they actually make money. Next, you need to take a step outward and look at other companies within the same industry. Stock prices are generally valued based on similar companies within the industry rather than looking at the market as a whole. So a tech company that produces $10 million in revenue might be valued very differently from a textile company that does the same thing. You want to look at your company in the context of the competitors within its industry. Is it a disruptor? Is it already a leader in the industry? Where does it fit in among its competitors? Be very honest with yourself about how competitive the industry is and how well your specific company is competing within that industry. That way you can quickly decide, is this a company I want to invest in, or is this even an industry that I want to invest in? Once you have a good idea of what the company does, the next thing to do is start looking into specifics in their 10Q report. This is a report that's required by the SEC, and you can find it both on the SEC's website or by going to the Investor tab on most public companies' websites. Now, I could do a whole separate video on analyzing the financials of a company contained in this report if people are interested. If you're just starting out and you want to jump into this, I would recommend skipping all the accounting parts and go straight to the management discussion section. This is a section where management will usually highlight the most important parts of the report for you. Now, as long as you trust the leadership of the company that you're investing in, this can be a good way to get a condensed view of all the insights that you need to know about the company. Finally, and this may be the most important step that a lot of investors skip, is to listen to the company's earnings report call. Companies are required by the SEC to release quarterly earnings explaining how the company is done and then providing some outlook for the future. In addition to these reports, companies will usually host a conference call where they discuss the results and answer questions from investors. By listening to these calls, you can understand what management actually thinks of the report that they just released and gain more insights into what they see as risks and opportunities for the future of the company. Now, you can listen to the actual conference call, but what I usually do is look up a transcript of the call after the fact. It's just a little bit faster to go through that way. Just type into Google, for example, Zoom earnings transcript, and you should be able to find the transcript for their last earnings call. Next, you should consider a stock price's volatility. Now, this is the first time that the stock's price actually comes into play. A stock's volatility is also called its beta, and it's just a measure of how much the stock's price has moved up or down in the past. By looking at this metric, you can gain some appreciation for how much your investment might swing up or down going into the future. A beta greater than 1 means that the stock you're investing in will generally have greater price swings than the broader stock market in general. A beta less than 1 means that it's less volatile than the general stock market. When doing growth investing, chances are whatever company you invest in is going to have a beta greater than 1 just because these stocks tend to be more volatile. But if you're following a dividend investing strategy, you may want to look for a company with a lower beta just so you can generate some more consistent passive income. Next, assuming everything checks out to this point, you may want to consider conducting what's known as a SWOT analysis. SWOT stands for strengths, weaknesses, opportunities, and threats. In this method, you can get a piece of paper, divide it into 4 with 1 square for each section, and then write down the different factors that are affecting your company. So in 1 square, you would write the strengths that your company has. In another, you would write the weaknesses that other companies might exploit. In another square, you could write the opportunities that the company is going to see in the future. And in the last square, you can write any threats which are affecting either the company's position in the industry or maybe the industry as a whole. Now, I took a whole class on just running a SWOT analysis, so there's obviously a lot more detail we could get into, but that's enough to get you started. This type of analysis allows you to construct a framework in which you can view your company company and any news that comes out around that company. This makes it easier to make informed buying and selling decisions based on new information that comes out regarding your stock. So next comes the stage when you decide whether or not to invest in your stock. You should now come up with a company thesis, basically a 1 to 2 sentence explanation for why you're investing in the company and what would have to change for you to stop investing. For example, if I was a dividend investor looking at investing in AT&T, I might say, AT&T pays a 7% dividend each year. In the future, that dividend is likely to stay high and its stock price will probably appreciate due to increased customer demand for 5G technologies, which AT&T is uniquely positioned to take advantage of. With this thesis, if AT&T drops their dividend, or we see that other companies start to outcompete them in 5G, we know that our investment thesis was wrong and we need to either modify that thesis or sell out of our investment in AT&T. Having a thesis takes the emotion out of buying and selling stocks and makes your decision-making process a little more grounded. Now that AT&T thesis was just an example. I haven't done any actual research into AT&T and I don't necessarily think that that thesis is true. And the last step, buy some shares of the stock. Doing your due diligence is important, but it's also important not to get analysis paralysis, where you spend so much time looking into the numbers trying to determine if this is the perfect investment that you never pull the trigger and actually invest in anything. Just start with a small amount invested in a company at first while you get more comfortable with analyzing stocks. Once you're comfortable, you can always start to put more money into the companies as you gain confidence in your analysis, but it's important to have some money on the table just to keep you invested in actually doing the work. And then finally, once you've bought into a stock, don't stop researching. Once you've invested in the market, you can't just sit back and let your investment ride for the rest of your life. Yes, ideally, we want to invest with a long-term time horizon, but we need to be continually monitoring the companies that we're invested in to see if our investing thesis has changed. There's a reason it's called active investing, and yes, it is a lot more work than just passively investing in an index fund. When you do decide to invest, one platform that you might want to look into is Webull, which will give you 4 free stocks when you sign up using the link in my description. What I did when I signed up for Webull was sign up, get the free stocks, and then I immediately sold those stocks just to get free cash. With that said, I hope you enjoyed this video. If you did, make sure to leave a like. And if you don't want to miss out on any future videos, make sure to both subscribe and hit the notification bell. I'll see you next time.